dump stocks now. I'm your host, Steve Van Metre, and thanks for joining me today. And our headline story today, Morgan Stanley's lead analyst, Mike Wilson, is telling investors to sell this rally and dump their stocks. We'll take a look at why he says that and if he's going to be right. Plus, the Fed is likely to be upset as we hear from Jerome Powell on Wednesday. And the question is, why is Powell likely to be upset? And what is he going to do about it? Perhaps the real story is, what is the Fed missing here? And last, we've got a piece where we're going to look at what's really driving the markets here. What is the markets looking at? Why do they think stocks are going higher? What is that case? Let's over to Bloomberg, where we start out today with Mike Wilson. Morgan Stanley says, don't buy the rally as Fed looms. Rally a reflection of seasonal effect and short covering, and markets are forgetting the cardinal rule, don't fight the Fed. And this is a case that many believe that when the Fed is easing, you buy stocks. When the Fed is raising rates, tightening financial conditions, you need to sell them. Let's dig a little deeper here to see what Mike Wilson is talking about. Better price action in stocks has started to convince many investors they are missing something, compelling them to participate more actively. A team led by Michael Wilson, again, Morgan Stanley's head analyst, wrote in a note recently, "We think the recent price action is more of a reflection of the seasonal January effect and short covering after a tough end of December and a brutal year." So what are they talking about here? What is this seasonal effect in January? Well, what happens at the end of many calendar years is people sell stocks due to tax loss selling. So now all of a sudden they have some cash to deploy from their tax loss selling, and in January they look to redeploy it, and this creates kind of a seasonal rally. This is what Michael Wilson is suggesting here. The other factor, which is kind of making this even more, we don't want to say worse, but driving the market even higher for those who are bearish, is the fact that we looked at this on Sunday shows in the past, that there's a large percentage of this market that is short. So when the market rallies and you're short, you take a double hit. You lose twice as much. So what he's suggesting here is, look, we have this seasonal effect where money's coming back into the market and people that are short are getting clobbered and are having to exit their short positions. He's saying in the short term, that's going to drive markets higher, but don't expect it to last. And if you need to sell, that's what he's saying you need to do. In reality, earnings are worse than expected, especially on the margins front, he said. Secondly, investors seem to have forgotten the cardinal rule of don't fight the Fed. Perhaps this week will serve as a reminder. And officials at the U.S. Central Bank are poised to raise their benchmark federal funds rate by a quarter point on Wednesday. Again, this is completely priced in by the market, dialing back the size of the increase for a second straight meeting. The move would follow a slew of recent data suggesting the Fed's aggressive campaign to slow inflation is working. But that's not the issue that Mike Wilson's bringing up. He's saying, look, don't fight the Fed. But is that actually true? Well, let's take a look at this next chart here, where we're going to look at the federal funds rate against the broad market. And we're going to have to find out that perhaps it's not true at all. Here you can see the federal funds rate in blue and the Wilshire 5000 or total U.S. stock market in red. And what we can note in periods where the funds rate is rising, we'll just say the overall trend is higher, we can note that the market actually tends to go higher. And we can see that time and time again, except this recent move here, we'll note that it was very quick, but that means you see the market came down here, but is looking like it wants to go higher. When in fact, what we tend to see is the market moves alongside the Fed, where you see, of course, at plateau here, the market tends to then look to a near-term peak or retest its all-time highs. And as the Fed starts to cut, you notice that the market comes down. And so this is a bit of a conundrum, to borrow a word from Alan Greenspan here, is what is going on when we look at these charts like this, is you want to see periods where higher interest rates are actually good for the economy. It's telling us that there's demand for money, and that because there's a demand for money, interest rates need to go up. And that's the sign of a healthy economy. Now, I know some of you are saying, well, wait a minute, Steve, hold on a second here. This demand for money that you're talking about right now isn't that strong. And you're right. In fact, we have this next chart as evidence which is the overnight reverse repurchase agreements, this is money markets. The total amount, this is not the total amount, but this is the amount of money markets being parked at the Fed, which is to the sum of $2 trillion. So we can make the case here, if there was this great demand for money, and that means banks had to raise interest rates and people were willing to borrow at higher rates because they were earning more money elsewhere by deploying their money into the real economy, then we could make the case that yes, higher interest rates are good, and what we're seeing here is good. But what we're not seeing is we're seeing two things that don't make any sense. On one side, we see the Fed raising rates saying we need to do this. On the other side, the market is saying, no, we don't see a demand for money here, and that's why rates are starting to come down. So you're seeing essentially this bipolar view of the markets being driven by the Fed and not the markets in general. Yet the Fed is unwilling to pivot to a more dovish stance, coupled with the reality of the worst earnings recession since 2008 is being mispriced once again, in our view, Wilson said. We think this should lead to a final leg of this bear market in short order. And so what he's trying to tell us here is, wait a minute, folks, before you get too excited that we're kicking off to the next bull market, this bear market rally isn't done. And that's why he's saying is, hey, wait a second, markets are going to probably rally here due to some seasonal moves, due to short covering, and you should be selling this market, not buying it. Hence the title, Dump Stocks Now, is what he's trying to say, because there's going to be another move lower that he will say is where you want to be buying. Strategists at JP Morgan Chase and Company have also said investors should sell this rally even if markets keep moving higher. Fundamental confirmation for the next leg higher might not come, and weaker earnings as well as activity could weigh on equities. Of course, we looked at that note here recently, but this is one of the driving things we've tried to suggest on the show, that markets are not a function of earnings and fundamentals anymore. They're a function of momentum and flows, and that's why on Tuesday, I'm going to remember to Tuesday to raise the price to $30, but here you can see CTA-Timer Pro. It tells you how the machines are positioned. It shows you why we're not seeing a big sell-off here, despite the fact that we're hearing from analysts say that. We see our faster algorithm, which is a few machines we note out in the market run, but broadly speaking, a lot of them running slower algorithms, which mean, as we've talked about on the Sunday show for weeks, we should expect to see machine buying. That will really hamper the short sellers and drive the market higher. If you're interested, it's $20 before I raise the price. Link in the description below, because what we're going to hear on Wednesday now, we're going to make a prediction that Powell is going to be very frustrated at the markets and try to talk them down. The question is, why? Fed's Wall Street clash set stage for Powell's hawkish message. Despite 2022's slew of interest rate hikes from Chair Powell and colleagues, financial conditions are the loosest since last February, as investors bet fading inflation will allow the central bank to soon cease raising borrowing costs and then cut them later this year. And so here again, the market now is trying to front run what we already know that the yield curve has been telling us. And we've been looking at this saying, look, inflation is coming down. The Fed will likely have to soon pause and then perhaps even cut rates if inflation falls below their target. Mind you, no one really believes it's going to actually fall below the target except a yield curve. That's likely wishful thinking as far as Powell's concerned, and he has clear incentive to push back against the trade, given rising stocks and bonds could fan the very price pressures he wants to restrain. He can just send a hawkish message. I don't think he's going to want the markets rallying out of this meeting. He doesn't want to throw more gasoline on this kind of optimistic spin fueling the markets. That, according to Bank of America. So I want you to understand here why Powell is going to be very frustrated is because he thinks he's the maestro of the economy, that when he talks, it listens. When he says tighten, everybody goes along with it. When he says stocks need to go down, they should fall. When interest rates go up because he's doing it, then broadly speaking, all interest rates to go up. And what I want you to see right now is the market is completely ignoring the Fed. And perhaps the real reason, the real answer here is the Fed has no control over the markets to begin with. And that's what Powell's concerned about, is if everyone figures out that they're just a puppet and have no control, well, then no one will listen to them in the future. Powell has sometimes struggled, here we go, to get the markets to take him at his word. And that is all that matters as part of the story of there is you see the market doesn't actually care what the Fed thinks, but the Fed cares what the market thinks Because again, all this comes back to one key point here is as long as the Fed convinces everybody is in charge, it is. If everyone realizes they're not really in charge to begin with, then the question becomes is why do we need the Fed after all? And now let's talk about the real reason we see the markets driving here is perhaps for one thing we've talked about on the show not too long ago, that's the dollar. The dollar's decline is a rare NASDAQ tailwind as earnings loom. The dollar is weakened by about 11% against a basket of major currencies from a 2-decade peak reached in September, touching its lowest since April. The trend will bolster earnings, here we go, at companies that derive a greater percentage of their revenue from outside the U.S., as a weaker greenback means foreign revenue translates into more dollars. It also adds to the broad view that a stronger dollar indicates financial conditions are tightening and it exacerbates the dollar shortage. A weaker dollar is actually good. It means the dollar shortage is getting better. Financial conditions are easing. The economy is starting to smooth out. So we're seeing that. But here's a chart we've looked at in the past that validates everything we're talking about. And here we see corporate profits after tax in blue against the nominal broad dollar index. And what we can see is when the red line comes down, corporate profits tend to rise. We can see that or at least plateau out. Here we're seeing the dollar come down. And that is telling everyone that, hey, perhaps we are going to see, of course, the markets come down here a bit, but corporate earnings and profits should hang up pretty well, all because of the dollar. Currency translations were a big headwind last year, but the fulcrum in the dollar will support earnings and growth exactly as I've said. As companies look out over the year, they can start to see benefits from where the currency is headed. Again, the market here being a forward-looking indicator, perhaps looking past Mike Wilson's call for a decline in stock prices, saying, look, we think we can get through that, and by the end of the year, things are going to look a whole lot better. But perhaps the real reason that we should be concerned is everyone views it as a tailwind when the dollar weakens. But the thing that's really on everyone's mind right now is demand. And that's the key point here. Is the economy on solid footing? There's a lot of evidence to suggest it isn't, but we don't know that yet. Time will tell for sure. But this is going to come down to a demand issue. In the meantime, the markets are looking at the dollar and seeing it going down and saying, look, this is a tailwind we want. If everything holds up, if demand stays intact, this is going to be great for profits and great for stocks. The real question will be is if demand crashes, well, watch out below. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.